Hello and welcome to ET Markets Smart Talk. I'm your host, Shraddha Janand, and in today's episode, we're asking an important question for fixed income investors. Are corporate bonds fund attractive? Well, joining me is a very special guest, Shriram Ramanathan, who's the Chief Investment Officer, Fixed Income at HSBC Mutual Fund. Shriram has over 25 years of experience in fixed income markets. Welcome to the show, Shriram.
Thank you, Shatash. A pleasure to be on it.
Thank you so much for taking the time out. And the Reserve Bank of India has maintained a neutral stance and kept the rates unchanged. Do you see this as a sign of a caution or confidence in the growth inflation outlook?
Sure, Shatash, I think it's good to just take a step back and just see what the Reserve Bank Monetary Policy Committee has done under this new governor so far.
Sure.
February, they started off with a 25 basis points cut with a neutral stance.
Right.
June, there was a 25 basis points additional cut, and with the stance change to accommodative. And finally, we had a 50 basis points cut in June, but again, a stance change back to neutral. So that's the lead up to this particular August policy
Sure.
from the Reserve Bank. I think the communication post the 50 basis points June cut was already fairly clear from the RBI that enough has been done, limited space for further accommodation. And in that sense, this particular policy, I think the fact that they have retained the growth projections, and although they have marked down the inflation, near-term inflation projections in this particular policy, I think
Right.
overall it's a sign of confidence. I think clearly retaining the growth estimate at 6.5% for this year and projecting 6.6% for the first quarter of FY26 in the volatile and uncertain context that we are in, obviously with a lot of news around tariffs and Trump tirade, etc. I think finally the RBI wants to show steadiness and calmness in all of this, that they don't want to be overly anxious and try to start estimating like the market is doing in terms of all the negatives. I think they have played a steady hand in this and they have stuck to their 6.5% growth. So I think it's surely a sign of confidence. One
Okay.
additional thing is it's also somewhere on the background. I would say a sign of caution as well,
Okay.
because also it is about not overdoing things in terms of the easing, right? Because already a lot of liquidity has been provided. Like I said, 100 basis points cuts has been done, so they don't
Yeah.
want to go overboard. And secondly, also the currency has been on a weakening trend, right? I mean, that's something to keep in mind. RBI may not talk about it too much openly, but finally, lower rates does mean pressure on the currency to weaken further. And somewhere that's where I would say it's a mix. Confidence as far as growth is concerned, yes, and caution as far as the currency and other elements are concerned. So it's a very balanced policy, I would say.
Absolutely. And we are seeing some bit of FI outflows already happening in the equity market space. And that's actually relentless selling that's happening. But yeah, that will be for a different day and a different conversation. But coming to the GDP part, Sham, what does the unchanged GDP forecast as 6.5%? You already highlighted in your earlier answer, and that is for FY26 and probably 6.6%. Yes, notch higher for the FY27 Q and FY27. Tell us about the RBI assessment of economic momentum.
Yes, I think the RBI has finally, like I said, stuck to its projections of 6.5% growth for this year. I would
Sure.
say marginally higher than where the market and a lot of economic research houses are at right now.
Right.
I think if you really see their assessments, I think clearly on the positive side, and which is very much true, is the fact that rural consumption is holding up well. It is resilient. I
Yeah.
think good monsoon, kharif sowing, etc., are also very positive signs that are there. Services continues to do reasonably well, and construction and other services are also fairly resilient. I think on the other side, the things to watch out for, and which is what they have highlighted in this, is clearly urban consumption. I think that's something, especially discretionary spending, is something that they have also highlighted, something to watch out for. We are seeing that in all the numbers on all the corporate results. So clearly, that's something that is on the weaker side.
Right.
Second is in terms of the fixed investments. While the government-led capex is clearly the strong point over there, I think private capex, we have been waiting for that to meaningfully pick up, and that's still something that's fairly tepid. And finally, the industrial sector is still subdued, right, in terms of the IIP numbers, etc. So it's a mixed bag. overall, I think what the RBI is communicating, again, like I said, with a 6.5% growth estimate, is that policymakers are on guard. They will do whatever it takes. The RBI has already done a lot of front-loaded easing. And very
Right.
importantly, they have ensured that liquidity, which used to be a big overhang for our markets last year because it was in
Mm,
deficit,
mm,
is
mm.
now a huge surplus. Durable liquidity
Right.
stands at 5 lakh crore plus. And
Sure.
that's the big effort. And along with that, there's still 100 basis points of CRR cuts yet to come into play, which they've
Right.
already kind of done with a forward a timeline in place. So I think a lot
Ah,
of things have been done. They will seep in through the economy. It takes
yeah.
time, and that's what the RBI is communicating. And I think on the other side, the government, I'm sure, and needs to be on guard
Mhm.
as well, because especially with the uncertainties on the external front, I think the
Yeah.
government will have to be very quick and proactive and nimble
Mm.
in terms of ensuring that the impacted sectors get the support that they require, and we
Mm.
push ahead on areas wherein we believe it's our area of strength on the global trade front. So I think, all in all, yes, it is a tall ask. Like I said, even we do think there is some more downside risk to growth from the
Mm.
current numbers compared
Yeah.
to where RBI stands.
Right.
And we'll see how no, things evolve. But I think our policymakers need to be on guard to take action as soon as downside risks materialize.
Absolutely. And yes, with inflation coming in at what, 2.1%, do you see, there's room for further rate cuts as well? And yes, we are on a wait and watch mode. RBI has already front loaded, you could say for the year 100 basis point. But yes, could there be another rate cut in the offing?
See, as far as rate cut is concerned, where we are today, I think the RBI governor has been fairly clear, right? And in some ways, you could argue maybe no, maybe a bit too clear because it takes away the hope and excitement and expectations angle of it, because
Right.
that's where the communications part comes into play. But he's been fairly transparent in saying, "Hey, monetary policy has done its bit.
Right.
It takes time. Now we have to wait and for it to seep in through the economy."
Yes. The transmission
Uh,
has to happen. Yes.
Exactly. And now
Right.
for a further rate cut, I think really it comes down to three things broadly. First one is obviously CPI, like you pointed out. CPI has
Mm.
already been fairly below RBI's earlier projections, right? There's a huge
Yes. Yeah.
markdown that they had to do in this particular policy.
Mm.
And the upcoming number also is going to be fairly lower as well as what our expectation is. So
Yeah.
CPI, but to a large extent, has already been preempted by the RBI by the
Mm.
markdowns that they've done in the forecast. So I don't think CPI
Yeah.
will be the reason for them to really go more aggressive with, let's say, further rate cuts. The
Okay.
second factor is growth. And like I said, alluded to earlier, as and when any growth negative impacts start becoming more clearer, let's say the
Okay.
tariffs become crystallized and indeed there is an impact on the export side, or even on our domestic economy side, let's say there's a slowdown. And
Yeah.
if indeed the 6.5% of the RBI turns out to be over optimistic and needs to get marked
Mm.
down to, let's say, 6.1 or 6.2%,
Sure.
that's where one reason why the RBI will start looking at, hey, is more required to be done. Third,
Okay.
and importantly, is the US Fed action, right? That's the other thing that's been changing over the last 1 month. Clearly, markets now are pricing in a September rate cut, more than two rate cuts by the end of this calendar year, and another three to follow next year. So that's what is now driving a lot of other emerging market bond markets as well,
Sure.
because as and when the Fed starts moving, it
Mm.
opens
Mm.
up space for a lot of other EM central banks because the
Mm.
interest rate differentials start opening up again wider.
Sure.
And that
Mm.
gives a bit more space and opportunity for EM central banks to act. So I think out of the three factors, inflation
Mm.
unlikely to be the reason for us to embark on any further rate cuts, but
Mm.
growth and the US action are two things that we are keeping an eye out on. We do
Yeah.
think that once the Fed starts cutting in September,
Mm.
somewhere in the Q4 of this calendar year, the RBI will probably have a little bit more space to maybe cut
Mm.
once or at the most twice. Once
Mm.
is probably more likely. But yes, it becomes like almost the end of its arsenal as far as rate cuts are concerned. So, but I do think that space might open up, and that really requires the growth downside risk to crystallize.
Absolutely. Now we've discussed about the rate cuts. We've discussed about how central banks are moving, both India and the US. So just from an investor's perspective, do you think corporate bond funds, especially with up to 5 years duration, look attractive now? What are your views on that as well?
Yes, no, I think that's a good question, because so far what's really happened is over the last 1 year, broadly, I think interest rates moving lower, duration funds have obviously had their time in the sun, and they were delivering good returns. But over the last 2 months, we have seen, and which is typical of any rate cutting cycle, that towards the bottom of a rate cutting cycle, rates kind of preempt the last few cuts. The longer end yields make their bottom probably before the last rate cut itself, and which is what we have seen this time around as well. We saw the 10-year bottom out at 6.17% in May, prior to the 50 basis points cut in June. And since then, we have been heading higher a little bit. So the duration play is a lot more tactical now. There's no secular structural move lower in longer end rates anymore, and which is where the corporate bonds start looking more attractive. Now, once you start drilling down into corporate bonds itself, I would say the space to look at is probably the underlying space to look at is 2 to 3 year corporate bonds, because that's where actually you get the best bang for the buck. Yields over there are now close to 670 as of now, 670, 75 for a 2-year corporate bond, which is the same as a 12, 13-year government bond as well. So you don't take too much maturity or duration risk, but you still end up getting a fairly attractive yield. Spreads over there are close to 80 basis points. That's widest that we have seen in quite some time over the last 4-5 years. So spreads are again very attractive. These used to be as low as 25-30 basis points about a year and a half back. So that's the second reason why corporate bonds in that space are attractive. Now, to your question of which fund category then makes a lot of sense, I would say it's probably the short duration category that's actually best targeted towards slightly lower maturity, less exposure to government bonds, and more to the 2 to 3 year corporate bonds than the corporate bond fund category that you refer to. In general, if you look at the industry, I think short duration funds are better positioned in this segment going forward. Or else you pick and choose a few corporate bond funds. Like I can tell you, the HSBC corporate bond fund is specifically positioned in the 2 to 3 year corporate bond space and has kept the duration fairly low. So that's the other space that I would say is good to look at. So to your question, good to look at specifically short duration funds, or pick and choose a few corporate bond funds which have lower maturity and duration, and not so much in the 5-year duration space that you refer to, because that becomes a bit too long, and there's going to be a lot of supply that we will see over the coming few quarters over there, which will keep those yields high and maybe going higher still. But the 2 to 3 year corporate bond space, I think it's extremely good, keeps risks low, gets you fantastic carry.
Great. So yes, 2 to 3 years is something which investors can look at. But if someone is looking at, with everything happening around at the global front and at the domestic front, what's your recommended approach for investors, let's say, who has 12 to 18 months kind of a time horizon?
Right. I think as from a fixed income perspective, I think, like I said, we are still in a way lucky that compared to the way bank fixed deposit rates and all are coming down very sharply, we still have fairly attractive yields as far as, like I said, 2 to 3 year corporate bonds and short duration funds are concerned. That 6.75 to 7% zone. That's not a bad space to be in. The second thing I would say is, now that we are in a stable regime, it's good to look at funds with a little bit of yield pickup play, wherein, in a measured way, you take exposures to AA plus, AA minus papers, maybe 25-30% fund. So typically a medium duration fund would be a category like that, wherein you start playing, okay, instead of 6.75, can I be at 7.25 or 7.5 kind of a yield on the portfolio, and keep the risk relatively still measured. I think the third thing, and that's a space that has really opened up, but it requires a slightly longer investment horizon, is the income plus arbitrage fund of funds, right? That's a very tax efficient instrument, or a fund that is a vehicle that is available. 2 years, you get 12.5% taxation for a 2-year period. So really, and the underlying is a mix of arbitrage and debt funds. And the good part is you can actively move across the debt funds from one fund to the other. The fund manager can choose to do that, and you as an investor really are not impacted on the tax side. So I would say 3 products. One is short duration funds for sure. Second,
Right.
I would say is yield pickup, medium duration kind of funds which play on the yield pickup. Third, the income plus arbitrage fund of funds. I think these are the three ways to play out the next 18 to 24 months from a fixed income perspective.
All right. Well, very insightful there, Shriram. And that's all for now. But Shriram, thank you so much for joining us and sharing your insights on the corporate bond market and the fixed income landscape.
Yeah.
And to our viewers, thanks
Pleasure.
for tuning in to ET Markets
Yeah.
Smart Talks. Stay with us for expert perspective and markets investment. Thank you so much for your time, Shriram. Then,
Cheers, Kshitij. Pleasure. Thank you.
thank you.